All right, welcome back everyone to this week's this live stream. We're going to be discussing the topics in the description below. You guys can check them out. Also, you can check out our sponsors. One of them is just me. And yeah, let's get right into it. So we're going to spend about a minute, just like me looking through the comments, let everyone in. So we're right on schedule at the 5 o'clock mark to actually get started. Okay, the open letter is so close to Iran screaming, uncle. All right, you guys are talking about the letter. Let's see here. If there's any questions, I basically just mark them. We'll answer them at the end. After this, I'm going to be doing the club member weekly call. So I'll be getting right into that. I won't be staying too late on this live stream today for that reason. Okay, so any questions? He's new. Bacon memes right here. Bacon memes right there. Sad future me and the VOD. Markets are focusing on SpaceX IPO. Also, we do have that trip today at 6 o'clock. So that's exciting. Going into space. All right, let alone birds talking about their citizens. Okay, birds talking about citizens. Letter. All right, so we're at the 5-minute mark. We're actually 15 seconds late. Oh my God. All right, so yeah, nice to see you regularly. I'm happy to do this regularly. Yes, I'm in Strongman's house. He's actually in the other room. He said I could use the piano when I wanted to. We have it a little bit, it's just inverted, but yeah. No, I do like this time for streaming. Anyways, so let's give the update on the Iran conflict. So we're going to get actually this live stream is happening before we know exactly what this presidential update. Oh, very fancy at I think like 9 o'clock today. So everything I say is going to be sort of surrounding that and speculating around that because we don't really know if it's going to be a nothing burger, if it's going to be anything material. I'm leaning on after some updates and posts from social media on the White House, it appears as though it could be a sort of like winding down, because keep in mind, I shared this, I believe, last week, and we've talked about, I know I had this big hiatus of not streaming too much, but I was also on Strongman's Rue Rabble. The one we did last year talking about the whole tariffs thing gave just this high level overview for all the club members. You know how we've been kind of pitching this thesis that a lot of the actions has really been about preventing a greater catastrophe, which is like this conflict with China. So avoiding that is the priority. So as long as those strategic goals are met for the U.S., I think that's all it really cares about. Similar to what happened in Venezuela, it's not necessarily an objective to just like completely topple everything. As long as those strategic objectives are met, then the United States can pretty much just like not really care about anything else that happens in the sandbox, so to speak. So that being said, the post that we saw today implies as though some language is going to be focused on, and let me open this image. Oh, okay, fine. I won't open that image that way. Let me try to see open image, a new tab. No, it just wants to download it. I guess we'll have to. That's how Elon Musk protects his website for me, not just like taking the image. So we got this post. I don't know if you guys saw it yet or not. But yes, Operation Epic Fury, destroy Iran's missiles arsenal, annihilate their navy, destroy the terrorist proxies, ensure Iran can never obtain a nuclear weapon. These were the stated goals that the U.S. government put out there. And so them posting this is very ominous right before the announcement. So we could actually get some sort of, okay, we did these things and, it's all good. As far as like the, again, broader thesis of what we were expecting and, kind of looking and checking our work to see if anything's kind of out of place, it looks to be the case that if anything, this was a pretty good example or sort of like test run of a sort of Cold War, a proxy war with China, U.S. versus Chinese military assets. This also resulted, I don't know if you guys have been keeping up, but this resulted in more disappearances or executions, however you want to put it. You want to call a spade within China's military industrial complex. So presumably over the failures of some of their assets. I believe the one in question was for one of their fighter jets. Trying to think of the other things, news that we've missed and haven't talked about since last Wednesday, because I don't want to repeat too much from last Wednesday. I believe after that, yeah, okay, so that covers the gist. So today we're going to hear more from the president on messaging, and looking at something like this, or when you see something like this, you can't help but think, perhaps this is going to actually start to be the wind down. As far as the market's concerned, on a look forward basis, the market's very knee jerk right now. We are in single digits. If you guys pay attention to at least the free resource of the Fear and Greed Index, which everyone has access to, you can see that we're in, I think, what were we, 9 the other day. And last Wednesday, when we spoke about the market's positioning, I pointed out that on Monday, that move we saw just shows you, it's sort of evidence to see where general positioning is at. So many people are bearish. So many people are positioned in a bearish manner that any sort of news, any sort of narrative change really shifts the value of assets. So in reality, nothing fundamental has yet been impacted to the degree that is implied by a lot of these share prices. A lot of the members were kind of jesting today about, hey, wow, imagine buying companies that haven't been affected, at least their business haven't been affected by the conflict. And sort of jesting because obviously in moments of panic and moments of fear, everyone sells everything. And that fear is what you can, as an investor, take advantage of. So all that being said, kind of circling back to the point, if we do see a sort of alleviation of this narrative, well, the reasons why we came down as a narrative, the reasons why we would recover in the medium term is, of course, change in that same sentiment that took us down in the first place. So the Strait of Hormuz itself, there was sort of like a lot of back and forth between members, between people in the public space, public forum, on what are the impacts of this. Does this matter long term? I think at the end of the day, when you read various primary sources from the US government, it was always identified as a risk on a go forward basis, and it's going to take some time. A lot of the Gulf allies are also going to take it a lot more seriously as far as like a risk goes. It's not that they weren't aware of it. It's almost like this sentiment or belief of like, hey, it's not broken, don't fix it. There's not this sense of urgency, at least in the past 5 or so years, to figure out ways to circumnavigate those issues. But now that was like the trump card you can only play once, pun intended a little bit, but that's a trump card you can only really play once before all of the Gulf nations start to try to figure out alternative ways to get the energy out of there without having that exposure to the risk. So but that being said, that's going to take years before you actually get the capacity equal to what can be taken out with the Strait of Hormuz. So people point out to the pipelines. However, also correctly, those same people point that the capacity constraints within those pipelines, it's not the same as the strait itself. So the other parts where we can alleviate, and this is the optimist, because I know you guys probably hear a lot of pessimism, so I try to lean on like more of the optimistic takes. The more optimistic take is that the other OPEC nations actually have more capacity that they can bring online than people realize or give them credit for. And so this can alleviate oil. And in fact, oil, maybe over the medium to short term, might be more of a, something that we're going to see pull back more than I think some people might expect. Last 2 weeks or so, we did see a lot of buying from retail in oil. And so if you find yourself doing that, again, this is like talking about that over positioning. A lot of people are going to be offsides, which is always the case, right? That's the nature of when you're outperforming, you're offsides, or sorry, you're not offsides. You're finding that most people are offsides at most times, and that readjustment is going to be felt by a lot of those people. But that being said, those of you who are more on like the on X, mostly the people we speak to who find themselves more on like the quant side, who are trying to be very nimble, have a nimble portfolio. Those people have been kind of pointing this out, that the relative positioning of most investors right now, it's not a strong time to consider adding shorts. Last week we talked about how short positions right now are probably the only thing keeping me up at night. Because of this like knee-jerk reaction that the market has on any good news, because what took us down was mostly the sentiment trade. And so what can immediately take this market up, and you can see very violent moves upwards, is of course this change in sentiment. But we'll have to see, because really it is going to depend on what news breaks that affects sentiment. There may not be any news that changes the sentiment. It might be a false flag, so to speak. So we will have to see. I don't want to. We can probably talk about it more next week. But if you want a prediction, just a fun prediction of what's going to happen, just reading this, it implies that perhaps it's going to be, something about, oh yeah, we did all these things. It's not, I think, immediate cessation, but if the market just knows that there's an endpoint, that would be very positive for at least the market perspective. And again, more bullish longer term. Anything that prevents the greater conflict from occurring, I view it as extremely bullish. And I guarantee you, most investors do not appreciate how much of a bearish scenario that is. The day that happens is the day I'm probably trying to sell everything I can. And, at that point, think about only shorts and holding cash. But that's not something that I think is on the cards now. And I think actually that risk has pulled back dramatically, at least for the next several years or so. But that was something that, the U.S. government was very concerned about starting in 2027. So let's see if there's any questions here that we can add to. Oh, thank you, Julius. Okay. We'll come back here and see if there's any questions. What do you mean by risks? No, it's not risks to those names, but we'll get to that. Yeah. All the objectives they released are near impossible to achieve, like the terrorist groups that slip between the eastern borders. Okay. Yeah, well, my thesis is not really that those are the actual objectives. At least not all of them are actual objectives. They're more like side objectives within a broader, larger objective. But yeah. I'm changing ethnicities. Okay, I agree with you, but that doesn't really matter. Wouldn't be the first time Trump comes out with saying the sky is green and everyone has to scramble. Yes. So this is the part where I think I talked about this in Strongman's live stream when he invited me on. So there's two ways of looking at it. And I try to appeal to those who, are neutral / love Trump, or hate Trump, because either way, the conclusion is the same. So either he's, employing what I believe, and this is because I find myself, I tend to be in the neutral camp. I see that he likes to employ the same tactic over and over and over again. People fall for it all the time. I don't know why they keep falling for it. As long as you, again, if you hate him and conclude the following, which I'll get to, the conclusion of your action as an observer is the same. So if you look at what he's effective employing, and we talked about this last year, he likes to employ chaos theory. He likes to do that in his first term, his second term. And in other words, in like sort of in a literary analysis, like when you're analyzing a paper or a book, there is such a thing as an unreliable narrator. And so the unreliable narrator is a narration style that tells you the truth, but also lies to you heavily. Lots of misdirection, lots of, you can say the same thing in the same sentence often, and both can be viewed as truth and not truth. And you're given clues, but you don't know what is a clue. And the whole payoff when you read a story like that is in the end, you find out what was the misdirection, what was not the misdirection, often used in like tropes where the person has a schizophrenia or something like that. If you watched a movie or read the book itself, Shutter Island is the example I gave to people. How it's an unreliable narrator. It's a story, and the narration style is that of an unreliable narrator. And you don't really know if the guy is crazy or not crazy, etc. And that's often the trope it's used in. So in that example, when you're looking at the president, he does a lot of things where I have these two clips that I always share with people as an example. It's the same quote, or not the same quote. It's the same interview within the exact 5 minutes, and in the same breath, he says two things that if I clip them separately, they're completely against each other, contradicting each other. And that's just like a fun example I always like to bring up, and show people in the club that even if you're taking like quotes from the guy directly in any interview, it's almost useless. Or if you use that as your only source, it's useless. And that's the problem I think a lot of people do, is they only use him as their primary and only source. And then if you hate the guy, you also can conclude, right, he's like a dementia retard person. And then if he's dementia retard person and you think he's like this babbling idiot, well, what he says doesn't matter either. And so the conclusion is still the same. It's just, why are you wasting your time beyond entertainment, reading and listening to what he says online? But thankfully, and don't take this the wrong way, but I think the people who do not think very clearly or illogically are the ones listening to him. And in this case, perhaps the adversaries are listening to him, which is nice, because if he's employing chaos theory or if he's a babbling idiot, it still has the same effect of misdirection. So, either way, whatever you want to conclude, the conclusion in the end is the same either way you think about it. So, yeah, but it is funny to think about it in that perspective. Okay. How bad do you think lawsuits will affect Meta's earnings? Okay, so for Meta's earnings, the lawsuits that they currently lost, we actually talked about them last week, I think, but the 275 million, that one's not an issue at all. When that was announced that they lost, didn't really move. The second one that was actually $6 million was actually more of the issue. They're appealing both of them. The one that was for $6 million just opens them up to a lot of liability. So the market perhaps thinks, on the worst case, 4,000 similar lawsuits times 6 million, big number, not much more scary. But what it opens them up to is this question of protections and who has liability for what content on their platform. That's more of the issue. It's not the losses themselves. Okay. No, I'm not positioning myself in gold at this moment. No. You like the Shutter Island comparison? Thank you. Yeah, I think that is that if you've seen the movie, then you understand what I mean with unreliable narrative. Because in high school, at least in United States, I imagine everywhere in the world, when you're just like practicing in your various language arts classes, you do go over the unreliable narrator example. And those are one of the more fun ones to read sometimes, because you just don't know what's going on unless you're really breaking apart each piece, and you might catch, for example, something. And that's, I think, the same exact way you need to apply it almost to the president's, public discussions. The comedian, I believe, Bill Maher, pointed out that, in person, he's a different person. And then when the cameras are on, his personality changes, which makes a lot of sense given his background. And that might, people hate it and people like it. It depends on the person. But in the end, right, if you view it from that view or you despise the guy, you still take the conclusion the same. Okay. We'll talk about are there any med tech names? Oh yeah, let me star these. Toast, great. Fight Club. Yeah, the flood of lawsuits. Well, that depends on if they're not able to appeal the one in California, because that one is a bit of a problem. Yeah. Okay, so Shutter Island comparison. I like Trump when he's not president. As president, he's dangerously scary, not in a good way. I mean, I don't particularly find him to be that out of the ordinary beyond rhetoric. So, yeah, I don't see, like, especially in foreign policy, the U.S. doesn't really change too much from presidency to presidency. So a lot of the adversaries of the U.S. tend to, miscalculate the U.S. and thinking that it's like hyper chaotic. But like, there's a lot of primary sources going back to, 20. Again, I mentioned it last week, but going back to 2013, talking about a lot of the issues we're dealing with today. And so that's not something that's like, changing from the Obama administration to Trump first, to Biden, then Trump second. It's been more consistent than what people give it credit for. Oh, thoughts on Cuba being next? So this is now just me opining as like an opinion. I'll opine as like an American citizen, and for someone who was born in Venezuela, for those who don't know. But yeah, I think if there is change there, that's going to be very positive from the Cubans. I know they're really excited for that. So I really hope it happens for them. There is like this, again, this is just now we're getting into just my opinions and stuff. But you know, it's like we could live vicariously through them, because a lot of the need for this change has to happen from the people themselves. Because Venezuela was an example of a country that's effectively broken, or kind of broken from the people's perspective. A lot of them complain right now. It's unfortunately that I hear all the time, sadly, that, you know, they're complaining the U.S. didn't do more, and I'm like, what do you want the U.S. to do all the work for you? You know, it's like you gotta pick up some of that weight, and the U.S. can help a lot. But I think that's majority of the reason why the U.S. didn't go harder, because I knew that from before it happened, that the Venezuelan people, in some sense, that they're like culturally or spiritually broken. The ones that were very revolutionary or uppity, most of them have left the country. So the ones that remained, it's like the spirit isn't there for change or for taking risk for change. And so it's not incumbent upon the Venezuelans to really expect more from the Americans. And the Americans, like you said, in the higher level thesis, all they're trying to do is achieve a mission, which is avoiding a conflict with China, making sure that they just don't do anything and they're just chill. So that doesn't equate to taking over Venezuela. It just equates to not allowing this like undue influence in Venezuela and resource denial, which was achieved. That doesn't mean regime change. And the same thing with Iran. Now, the difference with Iran and Cuba is there seems to be more of that spirit laid amongst the people, more than in Venezuela. And that could be positive. And for Cuba, perhaps, you know, there is positive change there. But in the meantime, right, you know, wait and see there. But I do imagine, in fact, in a 2024 committee before the Senate, the military generals at that time mentioned the four nations that were problematic and needed to be dealt with diplomatically or militarily. I shared this transcript analysis with the club members all the way back last year when we were first talking about this. The four countries mentioned: Cuba, Iran, Venezuela, Russia. I imagine, because they didn't say specifically, when you listen to the 12-hour interview on C-SPAN live, they did not say which one's which. That was very open, just that they all had to be engaged because, again, broader goal, avoid conflict with China. The Russian one, I assume, is diplomatic and through proxies, pressure through proxies. And then the Iranian one, we now know militarily. Venezuelan one, we now know militarily. We don't know what's going to happen in Cuba. But yeah, all four of those nations were mentioned, and 2 out of the 4 will perhaps be dealt with. So, okay, great questions coming in here. I've always found Google Maps to be attractive rather than Google to be an attractive buy rather than Meta, but Meta is interesting here, especially with GPT IPO coming. At some point, they will have to monetize through ads. So that's the one thing I'll say with Alphabet. So Alphabet monetization or Alphabet competition through ads monetization hasn't been a thing. It hasn't been an alternative for search type ads. GPT will introduce that for the first time in forever, because the thing with Alphabet bears is that they were too early. The real pressure was always going to be starting in 2026, where we'll actually start to see it. So GPT, with their 900 million plus, they're probably going to achieve 1 billion anytime soon of weekly active users. How can they monetize those search queries? This will be the first instance of Alphabet actually having a meaningful alternative for those ad dollars to go to. Meta is a totally different kind of ad environment, more similar to YouTube. And so it's not going to face that same threat. So you might actually have a potential new opportunity in Alphabet here soon. And so that's something I'm keeping an eye on. But right now, Meta is far cheaper than Alphabet. In fact, Alphabet sort of rose to this darling status. And I think that people forgot about the initial risk only because it was never meant to manifest. In fact, when I read through the B of A research on this, that's one of the points briefly back in 2025 that the analysts made on Alphabet itself, that the bear narrative was too early, first of all, because there really is no alternative for this type of ad dollars to go to. And we'll really see perhaps the impact of this later when GPT starts monetizing through advertisements, which we'll see this year. This is always the year, 2026. It may or may not be a problem, but the valuation of Alphabet assumes that it's not a problem. If it is a problem, the valuation will contract. By how much? Who knows? You do have the elimination of the other risks that were present back in 2025, which had more to do with the legal standing of Alphabet and whether or not they'd have to divest some of their assets. Those are gone. Now you only have the potential risk of ad dollar competition for search type queries. So other than that, yeah, Alphabet versus Meta. Meta's a lot cheaper. Meta has now this new legal risk, which will probably be an overhang for quite some time, but we'll see. Okay, let's see. What is the best way for small retail investors to position themselves offensively in a stagflation environment? So position themselves offensively in a stagflation. So you're talking about an environment where you're going to have inflation but low economic growth. So you're going to probably focus on, that point. That's you're screaming commodities, metals, etc., things like that, because things that are not necessarily tied too much to the health of the consumer. So if you're looking at things that are tied to consumer, then that's an environment where it's going to be fairly problematic for them. Like a company like Visa, MasterCard, those guys, they could benefit from the inflationary side, but they could also get hurt from the volume perspective. So if volume of spend does come down, or the average spend per person comes down on a real basis, that's problematic. So offensively, a stagflationary environment tends to be one of the harder ones to navigate. There's not a lot of businesses that are spared, unless you have a business that's growing tremendous. That's always like you could brute force your way through it, and you're growing so much so that it doesn't really matter. But SaaS or software businesses, depends on how much pricing power they're able to push through and how mission critical they are. That could be something. Believe it or not, and consumer staples can do okay. Depends. Depends on also like the setups, because I should also caveat all this. It depends on where the setups are going into that environment. Because if there was some other environment you were in that caused a premium to be observed in, like, let's say, consumer staples, that doesn't necessarily mean that in the next environment they're going to continue to do well if the setup already was very poor. But let's say they were at a low point, they were already rotated out, you could see rotation back in. But the thing with consumer staples, in a stagflationary environment, in theory, okay, they're staples, people continue to buy them, but do they have pricing power? Are they able to increase it beyond inflation? Is a question. So yeah, stagflation environment tends to be probably one of the worst economic outcomes. Okay. So let's see. Sunbelt Rentals. No thoughts on some other rentals. I like United Rentals, but no, Sunbelt Rentals. I know you have to buy it from the UK listing. I prefer United Rentals. I think they're a better capital allocator. All we got to remove the embargo and Cuba would become a capitalist country. Right now they're panicking because world's biggest superpower is hostile to them. I don't think so. On the embargo argument, I don't know if that's what's keeping them. To be honest, I think it's more so the regime that's in place that's not desiring the change, because they're the families that have benefited the most from the status quo. And if you're part of that apparatus, if you're enchufado, plugged in, you don't really desire the change. Things are good the way they are for you. Okay, so Venezuela. No. Yes and no. It's about removing their circle of influence in these countries. I know you're saying no. The whole point of actually why China even gained influence in the Middle East was that the Mid East felt that we were abandoning it, we were removing ourselves from it. So a lot of the, let's say the Saudis, the UAE, they started diversifying their friendships a little bit. So there was a brief moment, and this was, of course, when a lot of the alarmists came out of the woodwork and said, you see, like, the US is a dying empire, the US is this, US is that, it's going to lose influence to China, etc. And you can quickly see how all of that sort of just like dissipates, because they're all a bunch of morons saying it in the first place. And in this case, like China had already lost significant influence in the Mideast with the fall of Syria, now potentially with the fall of Iran, we'll see. And the US had actually gained influence in the Middle East. This is the optimistic way of looking at it. And I think that's the correct way right now when we're observing this. So if you're trying to simplify things and say like the access powers in this case, Russia, Iran, China, I believe that they're very much on their heels right now. And Iran itself had been weakened already through sort of like this, depending on who you ask, because I saw some stories saying that Hamas did the attack really without them wanting, so to speak, them to do it, or different elements of their government wanted it, other elements didn't want it, because the elements that didn't want it were like, this is crazy, this is going to invoke the adversary, we need to look scary, but we're not actually that scary. That sort of admission. And then other elements of the Iranian government were like, yeah, we're actually that scary. We're actually really strong, and sort of like kidding themselves in that way. So it's all about creating an environment. This is the high level to summarize. Creating an environment where China deems it not worth it to begin a conflict, and that conflict is sort of how I view it, ultimate bearish scenario. Okay, we got a lot of questions coming. Okay, so do you think recent software concerns will create newer multiples in the software? Yes, for some of them. Thoughts on QXO? I mean, you're betting on him to be a great capital allocator. Okay, so people in Strongman's Discord claiming Iran won. Oh, dude. Well, yeah, that's so the Iran is winning narrative. I genuinely I don't get it. I get where some of the nuanced takes come from it, saying like if the US does not achieve every objective, but I think what a lot of people are missing is what I think is very clear, because back in 2025, it was still, I think, clear, but more debatable amongst people. I think it's way less debatable now that there is a singular connection between all of the actions the US government is taking. And it's been pretty direct since the Obama administration, the pivot to China. The U.S. government has slowly been kind of turning its eye to where it needs to, and I think it ramped up a lot under Trump with a flavor of rhetoric that some people are not comfortable with. But a lot's been actually done, which makes me bullish, because it's preventing the greatest bearish event that I can foresee. And the whole Iran is winning thing, I get where some of the nuanced people are coming from. I still think they're wrong, but I respect their view on it a little bit there. But there are some people who legitimately think they're kicking ass, and I don't understand those people. So yeah. Okay, what Obama open trade with them? They started coming more open to capitalism when Trump closed the win. There is let's call it, how do I say? That's sort of like a naivete of Westerners a little bit. They're definitely not like you and I. So the Venezuelan regime and the Castro regime, they are snakes in every sense of the word. So the Venezuelan regime, if they can help it, their goal, for example, is to play ball until the U.S. doesn't care anymore. Right now, the U.S. cares, and they have to play ball. But the U.S. isn't going to spend a lot of resources in regime change there. Only, hey, we achieve our objectives. They're doing what we want for now, and then we just keep an eye on them. And then that's fine from the U.S. perspective. But they're not going to let go of power unless forced to. So the same with the Cuban regime. You are only going to enrich and entrench them. You're not going to necessarily change the state for the people themselves. So that there is two camps in the U.S., the carrot and the stick. Again, when we talked about the committee, they mentioned all those countries engaging diplomatically and or militarily. The Cubans, for a while, have still been trying to let's say look in a public space like they're willing to appease and work with us, and then at the same time, sort of like with their espionage ambitions, be almost against us. Not almost against us, literally against us, and more pro-Chinese. So that's been always a problem. And so Obama, I'm not going to say he was completely wrong and stupid for doing that. It was an attempt. It was a try. It was sort of like a nice attempt to see if that could work. And again, from a foreign policy perspective, that's not really the the U.S. isn't as chaotic as you might think it is. So concluded that the Cuban government was not going to just suddenly become a friendly government to us. So unless there's now this general fear that they'll have about their existence, then they'll just be, let's call it, tamed. But again, it's not really in the U.S.'s interest to regime change if the people themselves won't do it, because I don't think the U.S. wants to exert those resources. But it's not really like a need. Same with Venezuela. If they'll play ball, they'll play ball. As a Venezuelan, I would of course love it for the regime to change, etc. But I'm not going to expect that of the United States to just do all the work. Okay. There's a lot of questions to get through. Do you have any thoughts on Figma? I'm okay. Neutral on Figma. Is America hate? Oh yeah, probably. A lot of people have underdog bias. They hate the one that's like the most powerful, the top dog. People. Okay, so when we United States really is the sole superpower, and a lot of people do not appreciate that. They do not they don't actually comprehend what that means. They really don't. They say they do. If I say, like, the U.S. is a superpower, right? It's like, oh yeah, I know that because I read it in a book. To comprehend what that actually means is to truly appreciate the capabilities of the United States if the United States wants to do it. If the United States puts its mind on anything right now under the current power structure of the world, it can literally do almost whatever it wants. Not everything it wants, almost whatever it wants. It can play as nice or as mean as it wants to be. There's not really much others can do about it, and that's economical, political, cultural. It's a superpower in almost every sense, which is fairly unique, because prior superpowers usually had something they were maybe lacking in some capacity. But the U.S. in global positioning is fairly unique in that. But that's also a consequence of how advanced technology has. So it's also luck for the U.S. that it became a superpower at the time that it did. So the way it exerts influence is a lot easier than ever before. But anyways, are Russia and Iran poised to gain a lot wealth due to? So this is a great point. Actually, you brought an amazing point. So with the Iranians, yes and no, because the Iranians, at the end of the day, still their energy infrastructure is at the whims of the United States. I brought out a point to my members actually today. I organized it in a nice room for it, because I said this earlier this week or last weekend. But the energy infrastructure strikes, the reason why the U.S. would not do that, that's in my view, the way I think about it, is striking energy infrastructure assets in Iran is sort of like the U.S. getting desperate. So in broadly speaking, in the theme that I'm looking at, is if the U.S. wants to send them back to the Stone Age, easily could do it whenever it wants. Does the U.S. want to do that? Is that within the U.S. objectives? Probably not, because the U.S. wants something to be there, something that it resembles civilization to be there. So striking the Iranian energy assets, which take years to rebuild if annihilated, would not be necessarily within the framework of the U.S.'s plan. If the U.S. were to do that, it signals, at least to me, the way I think about it, is a sign, an act of desperation, which would not be positive. It would mean maybe something has changed, something on their timetable has changed. Who knows? But I wouldn't view it necessarily as a positive. On the other side of, or another way to think about it, is if you're trying to, enable or help out whatever comes after, if you did want to preserve the opportunity for regime change later by the people, destroying those assets would also be counterproductive to a potentially more friendly regime later down the road. And also, you're not going to make any friends really by destroying people's energy infrastructure. While some of the Iranians might say, fuck it, if it hurts them, it hurts them. Better for us, I'll take the hit. Maybe not everyone shares that. And so the US tactically destroying energy assets also would hurt. In the case of you're talking about oil production facilities, still hurts the US, still hurts the globe because you're taking supply offline and it's a commodity. So just because it's not going directly to you, as in Iranian oil isn't going literally to American ports, it still hurts American oil prices because the oil that someone else isn't buying anymore, they can go and they're going to start bidding up markets where the US does get oil from, or US allies, I should say. Yeah, in the case of Russia, good you brought that up. The Russian case, the United States has been providing intel to the Ukrainians for a while. We know that to be the case now, undisputably so. And the Russians obviously came to the United States and made it a point to say, hey, we'll stop providing intel to the Iranians if you stop providing intel to the Ukrainians. The United States, of course, rejected because the Russian intelligence is far less effective than what we have been able to give to the Ukrainians. And one of the things the Ukrainians have done recently is actually destroy roughly 40% of Russia's export oil capacity. So even though the price of oil has risen tremendously, the capacity or the impact that they've done, I think equates to 40% of 50% of their income base. I think it's 15% or 25%. I forget. I can't remember off the top of my head what percent of the oil industry is responsible for, or sorry, what percent of the oil industry is responsible for Russia's state income. I think it was 25%, but I could be wrong. Or it was 15%. But anyways, it was 40% of that figure. So even though we have this elevated oil price, it's kind of cool or fascinating that the Ukrainians were able to do this strike, because effectively it just, cuts that benefit by quite a large margin. And of course, you have to thank, U.S. intelligence sharing with the Ukrainians for that. It helps a lot with targeting. Okay, I'm pretty sure you already mentioned this. What do you think about Trump's address to the nation will be? So I didn't mention specifically. I said it may have something to do with the timeline on winding down, which could be very positive for the markets. The market just needs to see an end. It needs to witness an end. And what brought us down was the sentiment drop, this massive destruction in sentiment. And we haven't seen the hard-hitting impact on, let's say, any of the consumer, the economy, et cetera. We're still at a lower base point than we were in 2021. I believe the total cost on households will equal, in the US, speaking only for the US, $1,900 per year. If oil prices stay where they are, which is still impactful. It's worse than it was a few months ago, but it's not objectively a Armageddon moment for the economy. And if you actually do the adjustment on a real basis, I shared the chart last week. The price of oil has still continuously been declining for quite some time on a real basis, so adjusted for inflation, and has been becoming a smaller and smaller percentage of what of what budgets are for households. If you want it to get back to the same level or the same price on a real basis for where it was in extremes in 2008, or the original conflicts in the Middle East, you'd have to get oil about $200 a barrel, somewhere around there, in order for you to actually see that. So just to show you or give you perspective on the relative impact, $100 a barrel isn't what it used to be. In other words, it's not even what it used to be back in 2021, 2022. So it's much less, or not much less, but it is less than what it was back then. Okay, so I would love to do it. I'm just probably not in the same. I don't know who this person is. Like Dave Smith and Co. Yeah. I'm assuming these are like geopoll commentators. We're talking a lot about this stuff, but all for it, because this is important for investing. So I'm all for talking about it. And then we'll get to the other topics. I'm fine with going longer. Okay, so I doubt this is going to happen at all. Siding with Iran post fallout, highly doubt this is in the cards. This is like Professor Zhang type argument. But I don't think it's hard to find out who is winning. I will say this. So China is aiding Iran in multitude of ways, both intelligence sharing, but also in the cyber and informational warfare campaign. So a lot of the informational warfare that we are seeing, once you see it, by the way, you'll never unsee it. I just recommend everyone who we get into these conversations, just go read up on Three Warfare's doctrine from China, and then it will start to make you a bit more paranoid about information you read on the web, especially when they know how to get the algorithm, or they know how to manipulate the algorithm to get the word out there. And you can start to think a lot of people think a certain way when they don't think a certain way. And there's I forget what the bias is called, when and follow the crowd bias. I don't think that's what it's called, but that's a lot of the attempt. You see things enough times, you start to believe it. You see a lot of information, you get flooded with information, you might start to believe some of the nonsense. And one of the Geopol guys, I love the phrase he came up with. So I didn't come up with this phrase, but I find it hilarious. He always says, you got mind raped by third world propaganda. So I just got demonetized for saying that one word. But amazing stuff. And when we take that into account, like, you start to quickly see like what is obviously their angle, and you should start asking yourself, if they're pushing this angle, is it something that I'm being sort of forced into or corralled into thinking, or is it something that's organic and natural? So notice the language that they use. They're trying to always think about what is effective. The difference between now and 50 years ago in informational warfare campaigns is that you have instant feedback, so you know exactly what works and what may not work, and so you can see very rapid adjustments. So notice how politically it's kind of funny watching the bots online. They transform to political U.S. issues to try to garner support. Invoking the name of Epstein, invoking the name of various other political events that happen in the U.S. that stokes something inside of you, because they know enough people might think a certain way about those things, and they take advantage of it. And so it should invoke a question in you. It's like, who is pushing the messaging and for what reason? There was a lot of bot activity back in January when the riots were happening and the protests were happening in Iran. And it distracted a lot of Americans. It was very successful. In fact, I saw this firsthand among the club members in CM. I was seeing everyone in certain rooms only talk about this, like what I felt was a nothing burger situation. And there were content creators in the military space pointing out through what they know from work that or services as contractors. Brian McBath pointed this out. On it was like 40+% of posts online were from bots regarding that issue in January. And there was crowding out effect of the issue in Iran, and it worked wonderfully for the enemy, for the adversary. And then today, this whole like, I can't tell who's winning from the comment I just read. Yeah, a lot of that is the success of the informational warfare campaign. It's worked. I've spoken to real people, not bots, that do actually hold this opinion of they don't know who's winning. And it's not that it's you're stupid or anything like that. It's designed to work. It works for a reason. They do it for a reason, and it will work on a certain percentage of the population, enough where it matters. That's the whole goal there. And the same aspect with like the Europeans. I imagine a lot of you Europeans out there have felt this or have noticed it. Maybe some of you have, some of you haven't, with the Russian informational warfare campaign. And they're all, kind of trying to steer either chaos or towards a certain goal. And for an investor, right, we're used to this, hopefully. You're always trying to shift through information and figure out what is true, what is not true, what is material, what is not material. It's hard. It's not that easy. But it's a skill you need in order to, make a good investment consistently. So anyways, going through the questions. Oh my gosh, you guys are going wild. Okay, I will answer this question, company specific question, starring you. Any questions on companies we'll get to when we get to that section. Don't worry, no. Good. I want you to ask questions about any of the companies I mentioned in the title. Don't worry. I was talking about this comment and this comment, so no worries. 9 o'clock. Okay, second that. I believe Iran is the Middle Eastern country that celebrates some Western holidays, I believe. Well, yeah. So the people of Iran, the Persian people, which one of my good friends, he's Iranian. So this is when we always go to the gym together. So he's my gym bro. We're actually doing leg day today. And so he's very obviously passionate about this. He has a lot of family there. He actually looks he looks very Persian. He looks very Persian. But yeah, the Persian people are very much this sort of like to many who may have never experienced or interacted with them, they're very maybe familiar, I should say is the right word, familiar to those of you in the West. And they do celebrate a lot of the same holidays. They do think a lot. They do have a lot of the same values. They're just under a regime that's oppressed them for 50 plus years or so. So that's the situation they're in. They may or may not ever get out of it in our lifetime. Who knows? We'll see. This is the closest that we've seen in a while. America bad pundits. Well, I'd gladly debate them. Only not to convince them, but hopefully make the case to their audiences. Why America bad is a whatever argument. I don't see it as a title file. Yeah, we'll talk about Microsoft Hero. I'll start your question. The United States truly the only superpower. There's second beast in the Book of Revelation will soon enforce Mark of the Beast. Okay, I don't know much about that. Ryan and Maud, I don't think so. I don't know. I don't think so. To be honest, hard today's day and age. Most people are normies regarding policies, so they need to weed out the noise. Yeah, but it's hard. Bag holding her mess. Oh, we'll start this. We'll talk about her mess. Hell yeah, I love that. All right, so U.S. leaving NATO tonight? No. I think U.S. has expressed frustration and wants NATO to spend more. I don't think that's the announcement for tonight. I could be wrong, and I know you're NCM, so you can tag me and be like, you were so wrong on this. We left NATO, but no, I don't think that's happening. Nothing else. I hope you run called Persia after all this. Sounds way cooler. Yes. Well, hey, if you're a supporter of the Persian people, just call them Persia yourself. No one can stop you. So it's like a stance with them. You're standing with them. Why was my comment deleted? Someone sensitive and we no. I think something about when you say that word, because I can see if someone's deleted something on StreamYard. No one's deleted anything. YouTube, remember, has like the auto block stuff. I can't control that. Yeah, like all the time when someone's like commenting something, and I know it's frustrating. If you type a long comment on live streams or whatever, yeah, it gets auto blocked sometimes, and it's frustrating. All right, so we spoke about 57 minutes on this topic. So now we're going to talk about private credit, but you are completely allowed to ask questions on this topic. So I switched over the timestamps more to reflect that. So let's talk about the private credit bubble. So everyone has been talking for the past couple of weeks about this said private credit bubble. KKR, Apollo, Ares, Blackstone, Blue Owl, etc. All of these. The only one I find problematic among all of these is Blue Owl. So Blue Owl. Oh, great questions about Mercado Libre. Let me start these. White House and X tweets. Bro, well, man, I don't know, man. That's crazy. Sorry. Oh, by the way, thank you guys so much for the super chat. I should say, really appreciate it, especially now that I'm effectively retired, but I'm full-time the fun. So Always appreciate super chats. Okay, let's get right back to it. So with KKR, Blue Owl, Apollo, Ares, Blackstone, all of these, the only one I'm concerned about is Blue Owl. I think as far as like their reputation goes, everyone knows that they're perhaps the ugly duckling. I've posted on X about this a lot. Apollo's got I think the best underwriting standards with close followings behind them. KKR, Blackstone, etc. I think they all do good work. Ares as well. There's a ton of private equity funds out there, and not all of them are created equal. The top tier firms, I believe their books are relatively clean. I'll talk about some of the risks with Apollo. That has everything to do with some of the duration mismatch that may or may not occur. We do not have access to it. That's one of the things that people don't like about a lot of these private equity firms, that they're black boxes. And that's understandable. And there's going to be some sort of discount applied to that because not a lot of people don't like that. So within within Apollo, I should say, Athene has brought this duration match feature that has been this sort of concern always for banks for as long as we can remember. So banking institutions, a lot of what gets them in trouble is the fact that they borrow on the short end, they have deposits, and then they lend at the long end. This duration mismatch creates this opportunity for let's call a catastrophic event to occur. Private equity took that approach in private credit and introduced the concept of utilizing insurance float that's a little bit less regulated on what it can be invested in, and things like annuities and the like, and created this duration match, which reduced a lot of the risks that traditionally existed in banking. The underwriting standards, the underwriting quality or reputation from companies like Apollo precedes them. They're notorious for creating these extremely complex loan structures that benefit them in the end. They have there's like this joke about them that no matter what, Apollo's going to win. So no matter what happens, even if you go bankrupt, there's going to be some sort of way that they claw back a lot of this money and they come out on top. And so that's sort of the reputation they've garnered. But no, for the most part, all these private equity firms, the top tier ones, they have a good reputation for their credit standards for good reason. There's a ton of funds out there that have questionable credit ratings. And in this sort of shakeup that we may or may not see, we'll see who's not wearing any clothes when the tide recedes. Now, that doesn't mean that Apollo is going to suffer share price wise. Of course it will, because the sentiment's going to be very negative for a while. And in fact, you could still see, obviously, some form of hit. Now, what is the risk I mentioned with duration? Because I just went on a little rant about why they did all this thing with Athene and they matched duration, they removed that risk. Well, hold on. There's one part of their portfolio that they're actually taking on potentially some duration risk. I wish I could find out more by, for example, interviewing someone who worked at Apollo. I don't have that kind of access. But one of the main things I'd actually focus on is really in that duration mismatch potential with I think they're called the short-term deposit programs or short-term deposit agreements with the likes of BlackRock, Vanguard, and other institutions. On their books, we know they have about $37.5 billion. In theory, there's no issue as long as they're matching the duration appropriately. They remove that risk, i.e., you borrow 5 years because it's 1 to 5 years, the duration. So you borrow, if you're borrowing it at a 5-year term from Vanguard, hopefully you lend it out at 5 years and you don't create this duration mismatch. Or you keep it really tight. You don't create a lot of spread there, but you keep it really tight. And if you do that, in theory, should be good. Where things get hairy is because it's such a large number, 37.5 billion. If there is a private credit bear market, well, the thing with private credit and all these credit instruments, if they're not maturing, you have to sell them. And in a private credit bear market, you're gonna get a haircut on that sale. You're not gonna get what you lent out. So you're gonna take that loss. So let's pretend there's a private credit bear market where everyone's kind of bearish on private credit. It doesn't really matter as much for your origination if you're continuing to collect capital from not just private equity investors themselves, but even just like the annuities through the Athene capital raises. So let's pretend that's still going strong. But there's this potential problem that's created where, let's say Vanguard doesn't renew. They can't claw back the money necessarily immediately. But let's say the 5 years expires and just so happens it's in the middle of a bear market. So if that were to happen, you may not have the capital right then and there to replace it or to make good on it. So you'd probably have to sell some of those assets. And those assets, since you're selling them in the midst of a bear market, you're going to take that haircut. That haircut will go straight to the equity of Apollo in this example. That's the problem where I'm fishing for one, by the way. So that's the problem I can foresee beyond the straight and classical underwriting issue. So really the risks you have to worry about with Apollo is this underwriting issue. Like if all that we thought about them was wrong and there was an underwriting problem, that's a problem. If there is this duration mismatch, that's sort of like this other problem here to the side that I thought up of. So those two are the only two problems that really I see with most of these private equity firms. Some of them might be more pertinent to look at the credit underwriting. Some of them might be more pertinent to look at the duration mismatch potential. Most of the others, like Ares, don't have the duration mismatch potential. KKR also has the same issue with these deposit agreements, but much smaller than that of Apollo. So the problem isn't as big relative to the size of each business, because 37.5, that's mainly the issue, the fact that it's 37.5 billion. And again, I just laid out the circumstances that would have to happen. And again, we actually do not know if they're actually mismatching the duration, because if they aren't, there's not really a problem. If they are, potentially a problem. So a lot of ifs there, but goes to show you, it reflects the nature of appreciating these are black box instruments. So really delving into the nitty gritty sometimes is frustrating for traditional bank investors, because we don't get a lot of the same level of information. There's a lot of almost like a trust me, bro. There's some element to it, but I respect a lot of the folks that work in the space. And I don't think that, again, the top tier firms have a lot of problems. I cannot speak, obviously, for all of the other firms that are out there. There's so many of them and bound to be bad players. But one thing I'll point out and reiterate, if we recall the tricolor issue, a lot of the bears of private equity or private credit came out from the woodwork and started screaming about it. Well, I want to highlight to you that Apollo actually made money on those. And you remember that joke I said earlier about Apollo always coming out on top, seemingly, as you know, the kind of what people say. So in that, in those two bankruptcies that of course were fraudulent, a lot of that stemmed from fraud. Apollo shorted those loans. And in fact, you had banks, because everyone gives private credit players a bad name. There were banks involved in those loans. So that's not private credit, because private credit is a boogeyman word, but it's really a descriptive name, or poorly descriptive name, for an asset class that's just debt traded privately. It's just not a bond that I can buy. I can't just go out and buy these bonds. A lot of debt is private that you have to sell on the private market. But think of it, it's just debt that's not publicly traded. There's tons of that out there that we can think of, but it's not like a bond by Apple, etc. Or it's not this like, pool of securities, asset-backed securities that are trading on the market. So you can get access to these instruments in like CLOs, similar instruments like BDCs, et cetera, to kind of gauge a proxy for that. But yeah, so that's the gist that I want to talk about with private credit. Is it a bubble? I think a lot of people are talking out of their ass, frankly, but there are legitimate issues. Do I think that Apollo, KKR, and all these firms are bad actors? No, the opposite. I think Owl is potentially the worst actor, but even then they are not to the point where I would think about shorting them. I'm not mentioning Brookfield by name, but also include Brookfield in the top tier, et cetera, probably fine. And private credit or private equity, last time we had this experience, it was a really good buying opportunity. Andrew pointed this out the other day. We did see a lot of redemptions back in, I think it was like 2022, this like peak redemptions for the real estate. There was like a whole real estate panic. We had the real estate panic. Now we're having the credit panic. And all this like wave of redemption news, right, came out where you still saw a relatively strong resistance from some of these private equity names. A lot of people look at the redemptions and see that's a problem. And I don't understand that either, because that's more of the feature, not a bug of the solution. It is a private instrument, which means you have to sell the instrument in order to get cash. It's not trading on a public exchange where it's very liquid and you can find a buyer immediately. You have to go out and find said buyer. Sometimes you can sell it on the secondaries market for a nice haircut, of course. But you know, in general, the 5% limitations, it's like that's part of the product because it's a private fund. It's very it's not like your stock portfolio that you can just hit sell, assuming you're a normal size. Because if you're like, you know, billions of dollars, yeah, you have a problem. All right, my contribution to the destitute. Oh my God. All right, well, I have to read it. My contribution to the destitute. All right, thank you. Very very Catholic of you. I appreciate that. All right. No update on Galloway Metals, Dex. I'll do Star here. Great. And Turning Point Brands we'll talk about. Oh man, first. Oh, that's so good. All right. Let's see here. Oh, I see your question on Fortinet. All right. So Mark Rowan has acknowledged that KKR has done a good job copying them, but buying. Yes. Yeah. No. KKR. So I'm a fan. I'm a fan of KKR, Ares, Blackstone, Apollo. I'm a fan. Yeah. KKR's got some other things going for them. They got the private assets, if you're into that, on balance sheet, you know, growing that target of $1 billion in dividends from that by 2030. They have perhaps the best flywheel in the private equity space for finding and interviewing businesses and talking to management teams. So their pipeline, tremendous. A lot of great work. A lot of great people at KKR. Love it. Do you lump some? Yeah. I lump them in the top tier. So I think they're fine. My bias is KKR. I think to each their own kind of play. They can all do it. Yeah. No. And this is where I'm at. My top two that I've now leaned on. I think Andrew, my partner, he's KKR. I am slightly more to Apollo, but I'm KKR for meeting the circumstance of just having the bellwether, perfectly balanced, you know, like the Thanos meme, just like balancing the little knife, pretty balanced business and a juggernaut in every single category. So KKR is phenomenal. They got great buyout, great credit, great infra, real estate, well balanced. Blackstone, very similar, just larger. Now the difference between Blackstone and KKR obviously is, you know, the global Atlantic portion, and Blackstone's strategy has much been more of a custodian for various insurance partners. But yeah, I like that KKR is copying and getting the spread related earnings, because I don't see spread related earnings as necessarily a bad thing. Again, I love it that it's matching duration. For credit, it's great. For credit, it's amazing, and that's what it's for. So the private credit opportunity set is large. It's very large, and KKR going into the global Atlantic space, you do get that match and duration. You take on some of that risk directly, but in theory, if you're managing the credit book well, then that spread related earnings opportunity is pretty good. It's pretty strong. On Blackstone and Ares, well, Ares does have that minority interest in one of, or is it majority by now? I forget, it's majority or minority, but they do have an ownership in an insurance business. They may later take the whole thing, who knows? But Blackstone, I'll speak on them. They have a bunch of insurance partners, and they're taking on a lot of this perpetual capital that then they're investing into their credit book. So different story. You might like that one more. The multiple difference between Blackstone and the rest is higher, and I think for the most part, because Blackstone is the cleanest fee-related earnings story. Ares as well, but KKR and very much Apollo has a lot of the spread-related earnings. It's a consequence of the success that Apollo's had in Athene, that the spread-related earnings is so large percentage of their profit. So that's the thing with them. Athene is so big now, it's takes up a lot. It's great. Some organic growth to Apollo to actually shareholder friendly. Yeah. We'll talk about that. We did see higher. Yes. Insider buys from KKR. Opinion on Builder. We'll talk about that. Just Goon. Granddads. We love that. Non-stock question. Your strategy changed throughout the years. I remember feeling back 2022 and your portfolio was more spread out over the years. So I guess, so my personal holdings got a lot more concentrated because Meta, and there's not really anything that can catch up to Meta because I don't make enough money to put into the portfolio. I'd have to sell a Meta, and even after selling some Meta, it's like I have to sell a lot more of it to bring it down and spread it around. But I'd say not so much because the spread outness, so to speak, like in the holding co, I'm trying to run a more concentrated strategy. My personal holdings in terms of quantity of stocks is higher. Concentration is oddly similar because of what happened to Meta and Netflix and the like. But the in terms of quantity of stocks, it's still relatively sizable. I mean, it's under 20, but it's more than 10. I know the holding co has like 5 or 6 stocks, but I don't think it's changed that much. I think I took the liberty of adding a lot more, maybe you could say, risk to the holding co, sort of like a reflection of, maybe it's like a consequence of it being this, other portfolio where I'm alleviated from a lot of, let's call it mental concerns because I have the personal and then the holding co. But it's not that I don't care about the holding co. You know how big the holding co is. I do care about that tremendously. I don't want to experience losses there. But yeah, no, I've trimmed Meta over the years. I put some of my Meta capital into, for example, the fund for Fraxinus to start it up. So it's usually like been my piggy bank at key intervals to sell to buy, whatever really. But yeah, the largest recent chunk that I've sold of Meta was to throw it into the fund or transferred it to the fund. Yeah, no worries. All right, so let's go through the next topic. Let me adjust the timestamps. So we're going to talk about software and software rotation. We're talking about Constellation and all these other names. So right now it's 1 hour and 15. So we're going to adjust this real quick. Tier 1. Okay, so now let's talk about some of these software names that are noteworthy. And so if there's one way you guys want to support me, you have the, again, sponsors in the link. One of them is myself. If you want to join the Capital Mindset Club and the like, I will be doing the weekly call today. And we're going to be discussing, I think, first ServiceNow. And then the other one is the FinChat sponsor. So I do actually use the product. I don't take sponsors unless I use their products. So let's go to ServiceNow. So let's look at the overview of the price action. ServiceNow has not had a happy 5 years as of now, pun intended. Because if you go back many months ago, an investor in ServiceNow who bought the dip in 2022 was very happy. You're probably still happy, maybe not as happy as you were before. So ServiceNow, great business, great sticky product, great culture. There's not really much I can say poorly about ServiceNow. A lot of you folks in the corporate sector may have interactions and use ServiceNow at your enterprise, and you know how mission critical it is. Within the software space, because we're also going to be talking about Constellation software, you have a few key, let's call it overarching themes or different categories of software. You have vertical software and you have horizontal software. ServiceNow, horizontal software, great example. They can be used by multitudes of industries, not just one specific industry. And then when we talk about vertical software later in this live stream, we're going to be specifically talking about very niche products that focus on things like, let's call it chicken coop farming, library software, parking software. So very specific to a very specific vertical, right? Vertical software. Now in horizontal software with ServiceNow, the question has been, what the hell is disruptible by AI? What is not disruptible by AI? What can AI do? What can AI not do? In the case of ServiceNow, I view them as being much more of an AI beneficiary. There's a few other vertical softwares, horizontal softwares that we'll talk about that I think are also going to be these beneficiaries of AI. But ServiceNow in particular, I think they're going to be one of the ones who are going to be able to build a lot more products on top of their platform. And really what they are at the end of the day is more of this like platformized solution where you can build on top of ServiceNow rather than just building the layer all over again. And that trust that ServiceNow has built over the years is not easily eroded. With the business itself trading at a valuation, I think on a price to earnings is roughly, I think 23, 25 times around there. I think right here it says next 12 months is 23.8 at the current price. Relative to how much it's growing, I think you're actually getting ServiceNow at a really good valuation now that the rotation has left, or not rotation has left, but the rotation has happened in software. A lot of capital has rotated into a lot of these other names that perceive to be more safe. Yeah, right now the names that are benefiting us the most is companies like Memory, various infrastructure names. If you're dealing with anything with the infrastructure of AI, you've done really well. The hyperscalers, oddly enough, have not actually done well recently. And then software has been just absolutely killed this year. So ServiceNow, I actually didn't even show you guys this, but ServiceNow is down 30% roughly, give or take, this year alone or year to date. But if you actually take a look from the actual drawdown, it's actually down, and let's go with the 5-year. It's actually down 55% from the highs. So the part that's I guess you could say concerning anyone is if the growth is going to slow down, because this is the parts I point out with Adobe. I think the market is more concerned that the growth prospects for Adobe have declined, so that Adobe is going to grow at a slower rate than before. ServiceNow is one of the names that I don't think is going to have this extreme slowing growth anytime soon. I think they have quite a few more years of close to 20 or above % growth in profit. And we're going to see that slow down much farther into the future. So when you're underwriting this business, you take that into consideration. And I think you get to see that if there was a time to start a position in ServiceNow, this seems like one. And frankly, myself, I've started a position in ServiceNow. In the fund, we are long ServiceNow at pretty much this price here. So this is still a more wait and see approach, because I'm not calling a bottom. And if you're going to be so bold as to call the bottom, take it with you, the risks that are implied, because a lot of people who missed, for example, the one that's often quoted by people because it was up in everyone's face, the most visualized example of overhated and then rapid recovery, but Meta, that everyone likes to compare anything to like a Meta opportunity, when frankly, and I hate to burst everyone's bubble, that was a very rare opportunity, and you may not see something like that again, especially considering that Meta was so looked on by everyone. Everyone could see Meta, right? And that was unique, because normally with something like, especially something in the Mag 7 that has a lot of eyeballs on that almost never happens. So that didn't happen with Alphabet. Alphabet never got that cheap. And ServiceNow is not that cheap. It is not the same opportunity. It is its own thing. That doesn't mean it's a bad opportunity. That also means that if you're YOLOing at this price and you're thinking that it's that, you're delusional. It could be a strong buy here. It could have bottomed. It is not, trading at single digits right now. It's still trading at above 20 times earnings. Just keep that in mind. So I think it's a great business at a decent price for such a great business, where before it was at a crackhead multiple. And I don't know what the heck you were underwriting to assume that it was a great value back then. It was assuming zero disruptability, trading almost like a bond. And I think that's also a lot of the reset in expectations are deserved, because software is not a magical business, actually. The way it generates profits is the same as in principle as any business. It sells a product or service for profit. And the underwriting of said business and the valuation should just be derived of how much profit do you think it's going to make. And the closer it gets to a level of certainty, of course, there's a premium implied, because the premium or discount implies uncertainty or certainty. If we are hyper certain that a business is going to generate an X level of profit, you tend to see a higher multiple in that. If we are uncertain at all about the profitability of a business in the future, you tend to see a lower multiple. ServiceNow before had a level of certainty, equating it to almost like a bond. Now I think you have enough uncertainty put into the stock price, and relative to that growth, I think you're getting a good value here. It could get better though, and so just keep that in mind. So it's not something that I tend to have well, if you're so curious, I think in the fund, I'll say it this much, it is one of our smallest positions, more so part of a basket approach to software. So, but nonetheless, love the business, going to keep an eye on it, obviously. And if it gets cheaper and the story or the reality of the situation doesn't really change too much for them, then the opportunity is just getting better. But something we can monitor. So let's talk about Constellation Software. Now, this one is a fascinating one. And I had a question on it, so I'll come back here to yes, this happens, and it is a lesson, an expensive lesson, but you'll never do that again. So that's one way of looking at it. You'll always think about that. All right, so company specific question later. Any update thoughts on Constellation family of earnings? Blah blah blah. CSU is now at 17. Yes. Okay. So now trading at 17 times earnings. This is a really interesting opportunity because I think at the very least, they're going to be able to continue to accumulate companies and generating a roughly 15 to 17 to 20+% growth rate in not the cash flow available for earnings. We're talking about top line. The cash flow available to shareholders after adjustment or post adjustment, I think is going to grow even faster than that. And I think when we're going to see that probably easily get to 20% per year through various efficiencies. One of the things that I'm excited for with Constellation is I think they're actually going to be an AI beneficiary. I think one misconception people have, and you really need to talk to people who sell software, really need to talk to those people. But I'll share my summary of the discussions. So software is not something that's necessarily hard to replicate. Talk to the software engineers all the time. Every time this is brought up, it's like the creation or the replication of the product isn't necessarily the hard part. Especially in the case of Constellation, it's always been the case. Going back 10 years ago, it's not been the moat that was the deciding factor of why someone would switch or not switch. In fact, if I grabbed a very talented software engineer, 1 to 2 of them, let's say if I was one, me replicating the softwares that Constellation Software owns is not the hard part. Believe it or not, the hardest part is replicating the relationships. That's actually what's the difficult part. Selling software is way easier said than done. Anyone who sells software knows a lot of it has to do with the relationships you build and garner with the person. You can have great software. Sometimes, depending on what it is, and more rare than not, the software can sell itself. But that's more rare than not. A lot of times, there's a lot of effort put in to get a new customer onto your platform. And that benefits a lot of the incumbency. We're talking more B2B software. B2C software is actually a lot more fragile, believe it or not, in a funny way. So that, not to the one I think of that comes to mind immediately. So Adobe has 2 sides of it. It has the consumer side, it has the B2B side. The B2B side is the part I think that is way less under threat than people give it credit for. I think that one is going to be a lot more stable. Well, the part that I think people are maybe missing the plot here, again, on that question of what the durable growth is going to be on the consumer side. But the consumer side was the old growth story. That was why the stock re-rated so much as it did, even before the AI apocalypse. The narrative around the growth profile of Adobe was changing, was shifting beneath everyone's feet. No longer were they able to point to this like growing creator economy or consumer economy that was adopting their products. That part is a lot more, let's call it fidgety, very competitive, especially more let's call it easy for people to switch. I'll talk to people, right, who utilize Linux, and they say, well, I don't like Microsoft. I use Linux, but at work I use Microsoft, but at home I use Linux. As like a crude example of, again, kind of highlighting that someone in their personal life, in their own personal sense is more willing to switch. And there's other things that might be what keeps them around in terms of the modiness. So Apple has achieved something phenomenal where it's effectively created this like consumer tech moat, but that's not really easy for a lot of businesses to replicate in the software space. So, in the case of Constellation Software, we're talking about B2B. In that world, things are a lot more rigid. To change mission critical software is way, way easier said than done. If you build a better product, that's not the hard part. That's actually one of the easier parts. Now it's just actually getting the customers. Will the customer build it themselves? This is perhaps the more real risk because the other one has always been there. Now, will the customer build it themselves? Well, do they want to hire the staff that might be needed to maintain it? Or will the COO, CEO, whoever is in charge, will they maintain it themselves? Hard to say. I doubt that's going to be the case. Now, what's more realistic to happen is that Constellation Software and Topicus, which is another one I love a lot, Topicus, which has much more of a culture that differentiates itself, where it likes to create software internally, not just acquire. Because remember, with all of Constellation's business units, they encourage this cultural difference so that they try new things all the time. Topicus veered off to the side and created this culture of trying to figure out new products to build themselves. And I think AI enables a lot of this much more than before, which is why also I think it benefits companies like ServiceNow, who I think will benefit from all the new tools that they can build on top of their platform. So Constellation, I think, will be able to maintain their portfolio a lot more than before. And the cost of updating and upgrading their own software for their own clients will become actually a lot cheaper. And so what my long-term thesis here is for the software companies that are truly actually sticky, they are going to experience this margin expansion. The companies that are much more of like a very surface level layer to these interactions with other software firms, they might be the ones who are under pressure, either through increased competition and the switching costs aren't that much, or through the companies themselves actually replacing them because they're not that critical. And they might be more expensive than the headaches that they might be providing. So that's like a nuanced approach or a take I'd put on all the software. Now, what happened to Constellation? Well, my view, I think the answer is simple. What we witnessed was this absolute collapse in the valuation of the stock. Stock was trading extremely rich at one point, could do no wrong. Compounder bros for screaming on podcasts, et cetera, saying, you can't overpay for a company like this. Or I also heard, the valuation is high, but what if it was too low before? All in the times when stocks are going up sound valid because the stock's going up. So sounds perfectly reasonable. Almost like it's the exception to the rules because of recency bias. And then we find out it's not. We get humbled very quickly that no, it's not any exception. There frankly, it almost appears as there are little to no exceptions. But anyways, it really is coming down to the market previously viewed the flywheel that Constellation, this acquisition flywheel, as impenetrable and stable. Now it's just like, okay, any sort of question, well, yeah, it's trading at the highest valuation anyone's ever seen for the company. And now it's back down to the valuation where arguably it should be. And I think we can go here to just go to my ratios. I'm just going to use, because we're only doing a relative comparison, so it doesn't really matter what I choose per se, only that I choose something that's allows it to be comparable. So from a valuation standpoint, this is now the cheapest on a free cash flow that's ever been. Again, free cash flow available to shareholders is the most appropriate measure, but since we're doing a relative comparison, as in comparing it to itself, it's fine that we just use something as long as the comparison is consistent across time. So this is fine for illustrative purposes, but realistically for valuation, you see, it's not doing this thing properly. I'm trying to be your advocate here, FinChat, but you're not going back far enough the way I want you to. You know, don't shy out on me. But anyways, what it should be showing is that the valuation on just, again, relative comparison is not where you have to go back pretty far to see it back to these levels. So if you're scared of Constellation, really what you're thinking about is that the growth engine really is just not there anymore. They're too big for their own good, all these things. Yeah, Mark Leonard, yes, he did. He said our stock has to fall by something like 50%. You got that. I think because he's a pragmatic man. He looked at what they're currently producing in free cash flow, what realistically they could grow that free cash flow by, and what that implies for the forward return. So yeah, I think he's a very pragmatic man, and you can see, like, he's not a liar. He's not trying to pump his stock. And here, I think now at this price, you can probably get a pretty attractive rate of return if they're really if what I'm saying comes true about software stocks, particularly vertical market software. Okay. Let's go here. I think that's all the comments on Constellation Software. Let me see how we are. Okay, so then the next part, we're going to talk about 134. All right, we're going to get through FICO and Rocket. Mostly going to be talking about Rocket because we talked about FICO last week. So Rocket Mortgage. Now, this is a business that bought one of my favorite businesses, Mr. Cooper. So I liked Mr. Cooper, which is a mortgage servicer and originator, for the reasons that the origination business is the more volatile and cyclical part. But the more attractive part of the business, I viewed it as the servicing side. The servicing side is more stable, predictable, and Mr. Cooper had the lowest cost to service in the entire industry. Rocket Mortgage saw the same value in Mr. Cooper. They saw their ability to plug and play their own origination expertise with their existing portfolio into Mr. Cooper's servicing technology, and then lower their cost of servicing to the lowest in the entire industry and create a monster. And that's what effectively they've done. Rocket Companies today is a monster to what it used to be. Before, you might have known it just for Quicken Loans, all these other avenues, just getting mortgages, etc. It's broadly just like a fintech. Now, what Rocket Mortgage has become is the ultimate originator and servicer for all mortgage loans. And with the acquisition of Redfin, potentially actually a great challenger to Zillow and others for fully vertically integrating the real estate experience, which is very ambitious. I know that is their goal. I wished that Zillow would have gone in that direction. I've done videos in the past on Zillow and saying, like, Zillow could be the one that does this. I actually didn't foresee Rocket Mortgage doing it. But when Rocket Mortgage came up with their game plan back in 2025, that got me very excited about the future story of Rocket, because that told me that at least one management team out there had the vision that I felt was always obvious that someone should do it. And I could finally invest in a company that was executing on that. So I had it through Mr. Cooper, and have actually been sort of buying in and out of this name. I am back into Rocket Mortgage. For full disclosure, we're long Rocket in the fund, roughly around just a little bit under the cost basis here because of what happened in the past few days. But it's a recent additional buy, I'll disclose. And you now have this alternative. You could say, like, with FICO's narrative, has a lot to do with the regulatory environment and what some of these people think of on them, or like the perception that, okay, they're increasing prices a lot, but still like a low overall cost of the home, etc. Rocket doesn't really have any of that drama, but it is a story that's going to be heavily influenced in terms of like the stock price torque by the change in interest rates. So if interest rates come down a lot in the long end, or we just see, for whatever reason, maybe interest rates don't come down, but prices of homes come down, and you see this splurge in volume increases for buyers, and all these loans get either refinanced or you get, let's say, new loans, then Rocket is going to give you that maximum exposure to that torque. So, and anyhow, the servicing business acts as also this like more stable alternative within the business. They have the ability to, if interest rates do come down, to target all of their service portfolio and ask their customers if they would like to refinance. That's a massive marketing potential, and they have by far now the largest servicing portfolio out there. So this barbell approach, they're the best position. FICO, on the other hand, like they're also exposed to the volume story, but it's also more of how much they can increase prices by. If they can increase prices by, a consistent rate that's exceeding our expectations, and then the volume picks up, then there you have the story. There you have the story. All right, I have heard of Remax, and yes, so the Remax as a broker, now that's more of like the broker side. These guys are going to be more, from what I remember, like capital return focused. There isn't like a tremendous amount of growth. The networking fee, not the networking fees, but the sort of like, best way to describe it, I guess, is like you're taking a cut from all the transactions that your agents do. And so the game is like, how big can you grow your network? And by that, you're increasing the volume. So if your take rate on each transaction is lower, but your volume is increasing because you're attracting a lot more agents, it's still good. And if you're generating those fixed fees a year, because some agencies charge like a fixed fee, or there's like some sort of plan where up to a point there's this rate, and then if you make this many sales, it's maybe little to no commission sharing. So all that depends, but yeah, that's another one that would benefit. The strategy though there is a lot less defensible, often more viewed as like a race to the bottom to attract more agents. So there's not as much differentiation as there can be with something like Rocket, which will have a lot more differentiation. Again, it's really hard to compete against them if their cost of servicing is so low. So yeah. Oh, that's not Remax. I just ran about Remax. Is it a broker though? If it's a broker, same comment as it said for Remax, just apply it to them. But if it is a broker, it's the same opinion, because what I said is broadly speaking for all brokers. That's the problem with them. They are more race to the bottom. All right, let's go through. Okay, so now I finished the topics, and we'll get into the Q&A. Q&A 141. We'll be rapid fire through the Q&A because I do have an appointment, and I also have the weekly call. Okay, so in the Q&A, there's all these questions I got, and let me go through each of them. So sorry I'm late. Did I miss any updates on Affirm or Dave? So there's no updates per se on Dave, other than it's freaking cheap, man. But no, with Dave, I'd say this: they're doing a tremendous amount of buybacks. One of the benefits I'd say about our ability to accumulate at these prices, or continue to accumulate at these prices, which again, you haven't missed it, because that's a question that we broach to the management team. We get asked all the time. It's like, how I miss Dave? Because you look at the price, it's like, done a parabolic move since 2022. Dave, well, a lot of it since 2023, actually. Dave, as in terms of like earnings multiple right now, it's trading at pretty low double digits, 1 point single digits very recently. And the sell side right now, there isn't much coverage. So this is a consequence more so. A lot of you folks, there's a few of you I know that worked in investment banking that listen on. And you're like, yes, of course, this is a problem. So due to them SPACing, right? This is like one of the consequences of undergoing a SPAC. That money that you save SPACing, you might earn it back in headaches. What are these headaches? Well, the lack of coverage by the top shops in investment banking means that you don't get a lot of eyes on you. So there's a lot of work that they had to do to get a lot more attention or a lot more awareness of the business. And for a business, for a company, longer term, what you want is a stable ownership base. You don't want to have this like volatile trader investor base that's like buying and selling your shares. For the stability and the psychological impact on your employees, like, yes, you do want sort of this like more stable investor base. Lower shareholder turnover is better. There's a book on this. I forget the name of the book, but it's discussing like it's for CEOs to read. Gosh, I forget the title, but it's like about how to accumulate shareholders that are the best kind, right? The ones that are going to stick through thick and thin, et cetera. And the stability is positive for any business. So with the newer transaction they did, they're going to get a lot more coverage from the likes of JPM and others. So with the convertible note offering, so like it kills a bunch of birds with one stone. Not only does it give them an accelerated buyback opportunity, but it also opens the door for greater coverage where it matters. And I fully expect for something like Dave to over time get a lot more of that exposure. It's not as talked about in retail circles. I think largely due to the fact that it's what the heck is this company and what do they do, and the people who hear about it, oftentimes it's like from myself, Andrew, my other partner Michael, and a few others who on X have posted about it, but frankly have come to one of the three of us to discuss it. So it's not something that's talked about heavily. It's very rare if you see a lot of coverage on this name, which I think will change over time. But in the meantime, the update only is that, well, we know that they're buying back stock and they're still, growing at the rate we know they're growing at. So the fundamentals, we're there with it. Even now, right? It's not too late, as some people say. But yeah, in other words, like it's just a name you're going to be patient on. With Affirm, there was an update, and that was with Klarna, which is another company that's actually ridiculously cheap, in my view. But Affirm, or Klarna, I should say, got more funding from firm Elliott, right? So that was a vote in confidence on the platform, on the product. Affirm is in that same boat, guys. So if Klarna is getting this funding, that you can assume, right? Because Affirm's frankly, I said Klarna is really cheap, but you can assume that Affirm is also fine because they're the better underwriter. That's not up for debate, by the way. Klarna is the clear second. They're the clear number two. Affirm is the clear number one. And I can get into it if anyone's confused on the whole Affirm, Klarna, BNPL, because frankly, I should make videos on this to try to dispel the BNPL bullshit that's out there, because a lot of people have this misunderstanding of BNPL. And don't worry, because I was there. I understand where the misconceptions are, because it took me having a partner who's in the fintech world to fully understand what this is. It is not well understood. And I don't feel as bad, because he also told me, Michael informed me that, hey, well, a lot of sell side is like still on the books, or buy side is still on the sidelines here. Like, what the hell is this thing? So it's a lot of misconceptions out there, and I get it, because I was there. So if anyone has any questions on that, more than happy to go in, because I feel like now I'm very well equipped to explain it, because I understand where the gaps are, because I had those gaps. So if you have any questions on BNPL, I should just make a video and getting into it, because all the non-stock people who talk about BNPL, it's ridiculous. Like they go even more off the wall than is understandable. Like, let me find one video to kind of shout out in a bad way, because I think the research was very poor. Let me see if I find it. Yeah, it's this one with the burrito. It's this guy. So this got 1 point. Here, let me share this tab instead. So this got 1.4 million views. So this honestly was probably one of the dumbest videos I saw on BNPL. Simultaneously, a lot of the people who describe BNPL describe it as an untenable business and somehow taking advantage of people, when it's almost like you're just describing a charity at the end of the day. If I take you at your word, it's describing a charity. Buy now, pay later is just a neo credit card. It's a much better product for the merchants, for the consumer, and for the underwriter, so the lender, because it's a much more stable environment too, where it's going to be more flexible and dynamic depending on market conditions, whether credit is extended or not. Yeah. Also, this argument, too bad, firm makes up all their numbers, which is some short sellers out there, because they'll look at the delinquency rates and they'll just say that's too good to be true, because they don't understand what's happening at a firm. They do not understand it, or Klarna. Like, how could it possibly be this way? Well, that tends to happen if your underwriting engine is, first of all, pretty good, and also if you're underwriting every single transaction, you have a much more dynamic view on risk. But anyways. If you have any questions on that, feel free. So that's the updates. Turning Point Brands. So we got a article today discussing the potential problems. If you watched I did a pitch of Turning Point Brands on Chit Chat Money, or Chit Chat Stocks. Sorry, they changed their name. And in that pitch on Chit Chat Stocks, which is available on their channel, when I was asked and discussed the risks, it had to do with the FDA approval. That is one of the risks, and that came about, or kind of came back to light today. Stock at one point was down 20%, recovered throughout the day. I think it's a great value here. I think it's a great value here. If you think the pouch business is going to not be shut down, then I think it's pretty undervalued. There is some like controversial risk with potentially with like, and I've signed a low probability here to what's his name? Oh my gosh. How can I forget his name? Carlson is his last name. Forgot his first name. Damn, why did I forget his first name? That's crazy. When you see him, I'm like SpongeBob. You empty your mind, and it's like I only know stock tickers now, right? So I forget first names. Tucker Carlson. Fuck. Like, see, how can I forget that? So right now, you didn't see this, but in my brain, it was like the scene of SpongeBob. All my little Fabios were running around the brain, going like, "What is his name? We threw out his name." No, not Joseph. No, not Joseph. Tucker Carlson. And maybe they're related. No, I'm just kidding. That's blasphemy. So Turning Point Brands, I think it's a great opportunity now. I could be wrong. I think it's a great opportunity. All right. What is your opinion of Fortinet? I like it. Someone else asked the question, so I'll put both your questions together. But Fortinet, I love their culture of building everything internally. And frankly, in terms of where they're at, as far as like how they treat shareholders, phenomenal. Palo Alto, growth through acquisition. So the products sometimes are less cohesive, in my view, from also the conversations I had. Fortinet's culture of building everything internally leads to a more cohesive, and complete product, while Palo Alto is trying to take the approach of, in theory, you buy the best of breed, you combine them all into one package, and the customer will be happy, in theory. But yeah. All right. So opinion on Builder. I must Moon. That's not what you said. But yeah. So the you almost said Joseph. Yeah, I did almost, my brain. I buy now, never on. I buy now, pay never on Chipotle. Heck yes. I'm probably gonna get Chipotle today. You made me hungry. Wait, what was the start comment? I lost it. Oh yeah, opinion on Builder. So Builder is going to be much more of a play on housing construction. Where we are is in a so far a lull. The company's culture is much to just buy back tons of stock as much as possible. So I don't have an opinion or comment too much on where we are in construction and like what the market is set up for. I do tend to feel that there's a lot more pent up supply potentially coming online from existing homes, and really you just need an environment where interest rates come down. And right now we're not in that space. But if there is going to be a resurgence, which this does go in cycles, and you're in a lull cycle, which implies you should be a buyer of some of these stocks, at least having some position within your portfolio. And Builder First Source is probably one of the more amicable ways to play it. You have Top Build. I think you can also make an argument for QXO is also, if you want to bet behind Brad Jacobs, right? Buy QXO. It's got a premium on it, but maybe you say the premium's worth it for Brad Jacobs. You also have Installed Building Products, which is another one that no one talks about. You have Atlas Corp in Canada, small, tiny micro cap, but that one's another one. More Canada, but has some US focus, mostly all Canada. A lot of these companies are serial acquirers. Builder's First Source just has did I mention Top Build? I think I did. Has a little bit of leverage on it, so they're not afraid of shying away from that leverage. But yeah, no. All in all, I like it. I like it. I see a reason to have it in your portfolio. Whirlpool, no opinion on Whirlpool. Kind of screens as a value stock. But thing with Whirlpool, okay, so you're talking about now consumer discretionary, very competitive industry. Is it cheap enough? How's the debt? And if I take a look at Whirlpool, I don't even know what price it's at these days. So let me catch up. Wow, 54. Holy crap. This has died. Okay, because my mind mentally, it was at like $100 a share, because I have not looked at this in a long time. Seeing it here is crazy. What the fuck happened? All right, well, let's use our sponsor, finchat.io, to take a look at what's going on here. Okay, balance sheets, right? For those joke. All right, so cash, let's just look at like a high level view. Cash relative to debt. Okay, so the leverage, and I assume if I pull out cash flow from operating activities, well, do we have a separation? Let's just take operating profit. Well, I think we're fine with actually operating cash flow. Let's be more consistent and just do this. All right, so relative, what else do I have anything else? Operating profit. We can ignore that. But okay, so generally this level of leverage seems high, right? So I would tend back here, they had an opportunity to delever. I wonder what happened here. I forget. I think back then my past self would know. I don't know exactly what happened in 2022 that they decided to increase the leverage as much. Let me see. I hope it wasn't for levered buybacks, because they were never that cheap. So that would have been stupid. I love Hal's comment. Are tariffs still a thing? So many global destruction events, hard to keep track. Yeah, man. The world has ended like 7 times in the past year. Memory loss from years of inhaling cleaning products. Yeah. It does that to you, backbreaking work. What do you think when the entry point for Intuit now? I think all of them, I think entry points. FICO could get cheaper for my ideal scenario, but I think like for FICO 800 would be awesome. Would be amazing, actually. You may not get it, because the market may be at least aware enough of the quality of the business. But let's see. Okay, no, they made an acquisition of Insinkerator from Emerson Electric. Okay, but I'm also seeing here, yeah, they did do a decent bit of buyback. Damn. Yeah, levered buybacks can be a double-edged sword there. So not a fan of Whirlpool. Not a fan of Whirlpool. Okay, so they're good to buy, but as long as you have a clear understanding of what return you're going to get, it is likely you get an above market rate of return, but it is not an extreme likelihood. So you're going to own businesses that are almost indestructible. Their earnings are frankly very not stable because they are cyclical. There's a little bit of cyclicality to it, but guaranteed in the sense that there's not a lot of competition. Two phenomenal businesses, but just understand that you're not the first person. I'm not the first person. No one here is the first person to see, oh, wow, these are amazing businesses. At one point, you were going to get, or looked like you were going to get, an incredible buying opportunity because of the disruption of AI fears on these businesses. I don't think that's the case anymore. It looks like we've stabilized around where we are. We could see better, but yeah, just like it's not perhaps an opportunity that's akin to some other examples that are out there, but you're paying up for certainty of a business that frankly is not going to have much competition, much uncertainty about its future, etc. So kind of a couple ways of looking at it. You can get above market rate of return. I'd simply underwrite it as this. Look at the multiple it is right now. Assume it's a discounted to normal multiple. This is the lazy way of looking at it. What are they going to grow profits at? Take the multiple now, maintain it. The profits are your driver of share returns. Is that acceptable to you? Yes or no? Then go deeper than that. Start to ask the questions about what multiples is. Is it fair? Is it not fair? Is it over? It's under. Try your best to make the case of why it makes sense as an investment without assuming the multiple will be higher. Because then you'll never be disappointed. You'll only be surprised. You'll be like, oh my gosh, I was only planning on having a 12% return, but I got a 20% return per year, right? So, and focus on the question is like, should the multiple be less than what it is today? That's a super simple first principles based thinking on investing. You can't go wrong with that. Oh, Campbell Soup Company. Yeah. I don't even know what price they're at. You say wrecked. What is it? CPB, isn't it? Is it CPB? CB. Oh, sorry. I said CPB. I didn't even type in CPB. Yeah. I was like, why is it not showing up? I can't. Woo, 22. What the fuck happened here? Wow. What the actual? This is the time for staples to shine here. What is going on? I have no idea. This is catching me off guard. This is the first time I see this. What the fuck? Let me guess. They're gonna stubbornly pay the dividend until they have to cut it. Tale as old as time. They're gonna be like, no, we're never cutting this dividend. It's like, but we need the money. Nope. The dividend is sacred. Which I hate dividend whores, as investors. I'm like, you're literally destroying the company. This company should not be paying out money right now. It needs to delever. It needs to invest in itself. It needs to do this, that, and this and that. Okay, so what the hell is going on? So enterprise value is 13 billion market caps. Okay, so the debt's already getting up to the level of the market cap. This is like the market's way of indicating it's actually questioning the future prospects of the business. Where do we have? So yield, wow, they're paying out, look at this, they're paying out 85% right now of profits are going out as a dividend, when I probably guarantee you, just by looking at that EV, and they should probably prioritize some form of deleverage. Let's probably look at the ratios and the debt ratios here. It's going to probably be in here. Yeah, 4.5 is ridiculous. Okay, so they need to delever. There's a lot of funds and institutions out there that won't look at a firm if it has over 3.2, something like that. It's in the threes. So 4.5 is ridiculous. You could get an immediate valuation bump if you focused on debt repayment, and you drag that down back to like 3 and under. You would get a lot more participation in your stock. But this is now just like stupid. What have they done to this company? This is an example of just like poor management and this like absolutely retarded philosophy of dividends at all cost. I don't know why so many people repeat the same mistake again and again and again. It's like, you don't have to pay a dividend all the time. This like culture of having a dividend, increasing it every single year, regardless of what happens, implies that stability is known that far out into the future. I think companies that have variable dividends or token dividends with a special dividend, if you must have dividends, is much better policy. So an example is like Progressive. Progressive is like an amazing example here. Costco is a great example here. Like those guys have the perfect strategy. It's Costco has a standing dividend that's token. Like it's just there for, especially if you've been invested in it for so long, your yield on cost, phenomenal. But what they'll do is, okay, this year we made so much money. Here's some little extra. Here, we've accumulated so much cash. We have no idea what to do with. Here's a special dividend. That's great. That's the way you do it. Progressive, same thing. Progressive is like, we made so much money this year. We have no idea what to do with this money. Here you go. Here's a special dividend. Like last year, they paid out what, like $13 in dividends. So you have the standard dividend that you grow, but it's always so small that it never oversteps itself. When you're talking like a business that is pretty levered and has 85% of the profits going out as a dividend, what are we doing here? You know? So can't say this is exciting. This could be a value chart. They need to cut the dividend yesterday, start delevering, and focusing on what they can do with that capital to grow. Either, figure out creating new brands, buying something maybe when you delever. Like these management teams, man, it's like, what do they study? Yeah, like, well, the high yield ETFs depends, but yeah. Show us the debt. Yeah, sure. I'll show you the debt. Show us the debt. Show us what is behind the door. All right, so yeah, you can see the same story here playing out. So they did it. They delevered, and then they levered up again. I don't know, man. And I assume if I throw operating profit here, I'm gonna see a story of just like, okay, so they got a little bump in 21, and since then it's been really weak. I'm just gonna quickly glance at this to see with my eyes if, okay, looks like it's just margin compression. So they're getting pressured on the margins. I bet you what's happening is input costs are going up. They don't have the pricing power they used to. So margins are getting compressed. I mean, that seems obvious because you got sales going up. I don't think it's product mix per se. Where they occupy has usually been the value category, just like what I understand about Campbell's. I think they've acquired some premium brands, but most of the time it's like they have great brands. If this company were to ever die, I could see another firm, private equity coming in and scooping up some of these brands, like was it Pilgrim's Farm or Pepperidge Farms? Pepperidge Farms, like the little Milan cookies, etc. Like that stuff's addicting as hell. I haven't had those in like a year, maybe more. Maybe that's why the stock's down. I haven't bought those in a year or more, but no, they're pretty good, Milan cookies. So the soup brand, like it occupies the value side. So I don't think they have a lot of pricing power with consumers. Probably the issue, frankly. Okay. Sorry to repeat the question. No, don't apologize for repeating the question. I love questions. But thoughts on the Melly credit expansion. I had a light bulb moment when I saw Dave Similarities with the loans, rapid turnover, and basically an in-house FICO of data. Yeah. So Mercado Libre is phenomenal culture. Similar to, well, I've said this before. Every time I talk about Mercado Libre, I make a point to highlight this. They have a culture of building everything in-house. That can be a bad thing, can be a good thing. If you have the good talent, great. But in their case, they have the good talent. They built everything to facilitate the necessity to grow the e-commerce business. Very similar to Amazon. Amazon needed an Amazon Web Services for themselves. They said, fuck it, we'll build it ourselves. The difference between Amazon and Mercado Libre is that Mercado Libre is operating in countries where the financial system isn't very developed. So they had the Amazon moment. They said, do we just wait for someone to build AWS, in their case, banking, or do we build it ourselves? They built them themselves. So Americans or Westerners really do not appreciate how underdeveloped the banking systems are in many of these Latin American countries. There is not a lot of competition. So Mercado Libre is getting net interest margins that blow everyone out of the water. When an American bank analyst looks at Mercado Libre, knowing what they know about American banks, they're like, how the hell are they doing that? Well, the answer is simple. The net interest margin that people get on banks in the United States are a reflection of the highly competitive nature of banks in the United States and the relative stability of the actual money. Because what net interest margin doesn't explain as well or add in context is inflation. So when you hear someone talk about net interest margin and forget to mention that, also, kind of, they may not fully grasp or appreciate the Western bias, right? So net interest margin is also a reflection of the inflationary expectations of the country. Because embedded in the implied interest of a credit product is both the credit risk profile, the alternative or opportunities, right? So if you're the only lender in town, you can charge a higher interest rate, and also a reflection of the, inflation of said environment. So if you're operating in country X and the inflation is 50% per year, interest rates are probably also going to be higher. Net interest margin on a nominal basis, on just like the surface look, is going to be really high because your cost of debt versus your what you're lending it out to, it looks like a really high percentage. But in that factor multiple, right, between the difference between, like, say, the US and country X, is the relative difference in inflation is embedded in that. So that's a lot of the reasons why it's so high. But yeah, most of it, lack of competition, underdeveloped markets for at least the finance side, and a relatively higher inflation rate. So nominally, you're going to have a higher perceived interest rate, but real interest rate, it's going to be a little bit lower. And as far as like data on the consumer, they got it. They got plenty of it. I think it's I think for Mercado Libre, when we're looking at how sticky and the flywheel they're building, there's what is not to like about it. So I love the e-commerce side. I love the fintech side. I love Mercado Libre's culture. Their new management came in, or the new CEO came in. Great guy, great interviews. Well, actually, with new technology, like, you can listen to the interview and have it dubbed in English. But I speak Spanish too, so for me, I just been eating up all the interviews he's done as well in Spanish. And so, but he has some interviews in English as well, so it's not like you won't find anything. But I recommend even some of the Spanish ones are really good if you can find them dubbed in English, or if subtitles are fine for you, or you can download the transcript, go to an LLM, translate it to English, whatever way. But yeah, I like the guy. I think he's good. So on the question of thoughts on Mercado credit expansion, I have no negative thoughts on their credit expansion. I think it's going to produce a lot of shorter term noise, and similar to Klarna, how Klarna, everyone got spooked by them having to record upfront costs. I don't find an issue with that. I'm thinking about the longer term, what that's going to look like with Mercado Libre. I'm telling you right now that the underdeveloped banking system, there's so many ways they can monetize. It's crazy how underserved some of how Latino families are in Latin America. So a lot of the banking products you can think of, they can bring it right to them. Investing products, retirement products, savings products, make it super easy for someone in Brazil, Argentina to deposit money, immediately deposit into dollars into what is they understand is a more stable currency, and then have it in a high interest savings account or a treasury account. And Mercado Libre takes a small little cut of all that money. And now you're using Mercado Libre for your shopping, for your banking, spending, borrowing. Yeah, great. All great. So then Melly's 23% ML isn't perfect representation of the value created per se. It's like NIMO minus inflation equals the owners. Yes. But nominally, yeah, like you're going to see it's high. Also account for inflation. But even when you account for inflation, because inflation in like Brazil, Argentina right now is a lot more tame than it used to be. But even when you account for inflation, I should say it reflects more the stability of the coin, because the market is going to reflect the stability perception of the coin. But even if you account for it, it's still tremendous because there's not a lot of competition. So, but generally, interest rates in these countries for loans products is generally higher. But that doesn't make like their banks immediately superior, because banks per se, the primary. Okay, so the things that banks are focused on, and it's like why it's misjudgment to say like a bank in Brazil is just suddenly better than a bank in the United States because the net interest margin is higher. Well, aside from the reasons we just stated, in the U.S., a bank as a business model is concerned about a few things. Duration risk, which is one, we'll put that to the side, but it's mainly credit risk, right? So, well, actually, let's not brush off the duration risk. So duration risk real quick is like people don't run to the bank and withdraw everything, right? Because you're borrowing at the short end, you're lending out at the long end. So you want to be wary about that duration risk. Okay, but put that to the side. Credit risk, are you lending out to people who are not going to pay you back? And then on top of that, right, if you're focused on that, focusing on people who are going to pay you back, and you'll see you got the credit risk down, then it's about levering up, right? So you lever up your book and you generate so even a net interest margin of 5%, 4% is going to be really good because you have general stability or expected stability in your book, and that 4% with leverage gives you a good rate of return. In Latin America, you might have the higher interest rate, the NIM might be higher, but that stability factor might be lower. And so it kind of is like a judgment call and takes a lot more critique to look at it and make an actual value case of like, is the instability factor, higher than what you're getting in like the NIM. So the NIM is all fine and good. In the US, you get a lower NIM, but the stability enables that almost like security in the leverage. Like, I lever up because I know exactly what I'm getting myself into. So so having a lower NIM is not that big of a deal for a bank if they can make up for it and having extremely high quality underwriting standards, assuming the duration risk is not the issue, because that's what killed First Republic. First Republic Bank had phenomenal underwriting, phenomenal clients. The credit risk was like zilch on their stuff, but the duration risk is what killed them. That's what killed First Republic. It's an omen to bank investors to worry about the duration risk. I think I slipped through though. UNH. Healthcare insurance looks really good here. It's looked good for a while though, but yeah, it looks good here. I don't even know what. Oh my god. Well, it's still around the same price. Generally, like I'd stick to UNH though. Between those two, the valuations are similar enough that I just stick to the top dog here. Banks in Brazil also okay with tons of physical obligations, whereas Melly's CAC. Yeah, exactly. That's also true. Yes, exactly. Yeah, and Nubank is also a phenomenal player there. Very innovative business. All right. With that being said, everyone, thank you guys so much for joining me here today. So for club members, Weekly call will still be today. I went a little ahead of what I was going to do here. Apologies. So weekly call will be when I get back from my appointments, because I have an appointment at 7 p.m. So I got to eat food. And then so weekly call will be around 8 p.m. just in time for the Trump announcement. Maybe I did that on purpose. You know what? At that point, might as well make it 8:30. So we have it right there. 30 minutes in, I'll give a little bit of coverage. We'll get the Trump announcement in. We'll all panic. We'll all look to Dave Hahn for guidance. Dave Hahn will just ask, where are futures at? And then Ricky will go look at the futures. And then, everyone's going to, yell Lisan Al-Gaib to Dave Hahn. And there we go. Yeah, for all the that it's now an inside joke. But anyways, hope you guys also like the meme video from yesterday, if you guys found it funny. Oh wait, I had another starred. I had a nice comment from Grandizer. Y'all should join the portfolios at 8% 25. You'll learn and understand businesses, financials. Yes, so great advertisement, always great advertisement from spreading word of mouth. Thank you very much for the kind words, Grandizer. All right. With that being said, thank you guys so much for joining me today. If you guys enjoyed the live stream, again, stay tuned for next Wednesday. We're doing every Wednesday at 4 o'clock. Go tell your friends about it. If you liked the stream, feel free to like, share, subscribe, follow on X, however you want to watch me. And you can check the description below if you're curious on joining the Capital Mindset Club, where you can talk to me every single day. And see the portfolio updates and the like. And also, if you want to support me in another way and you're using already finchat.io, or you're interested in using finchat.io, please use the link there, and that helps support me as well. With that being said, thank you guys so much for joining, and I'll see you guys on the next one.